All right, my friends, I'll give everybody about 1 minute to hop in the channel here for the live stream. Looks like Citadel Securities is desperate for cash. They need to raise over $500 million, according to this latest issuance. And the SEC has charged Robinhood with more securities violations. More. They were recently charged in September of 2024, and then a few months before that, and a few months before that, and so on. You get the idea. I think it's time for people to say that they've had enough. Welcome back, folks. Paul, Olesia, John, Daniel, it's great to see you. Terry, Philip, Eagle, Bernard, welcome back. Here's what's going on. It's really quite simple. The Securities Exchange Commission has charged Robinhood with yet more securities violations. This was just released late yesterday afternoon, and they have violated a ton of shorting regulations, reg show, blue sheet, suspicious activity reporting, unauthorized access, you name it. From December 2019 to 2023, Robinhood mismarked more than 15 million principal short sales as long. Ladies and gentlemen, this is the definition of cooking the books. Robinhood marked liabilities as assets for a period of over 4 years straight. 15 million short sales were marked as long. They did not comply with locate requirements for any mismarked fractional trading and recurring orders, principal short sale orders to be specific. Meaning they violated regulation show of the securities laws. They cooked the books and mismarked short sales as long. By at least October of 2020, Robinhood Securities was incurring intraday net short positions that were causing it to incorrectly mark principal short sale orders relating to fractional trading and recurring orders as long. The monthly incidence of incorrectly marked principal short sale orders peaked in February 2021 at more than 4 million. Have any idea why? Can you take a guess, ladies and gentlemen? What happened in January of 2021 with AMC and GameStop and the SLV ETF and COS and a dozen other securities? As a matter of fact, 50 securities at their peak were made position close only by brokerages like Robinhood. Let's go over this. According to the Securities Exchange Commission's charges against Robinhood that were issued yesterday, January 13th, 2025, from January 2020 through March 22, Robinhood failed to timely investigate suspicious transactions, resulting in systematic failures to report suspicious activities. Identity theft protection. From April 2019 through July 2022, Robinhood failed to implement adequate policies designed to protect their customers from the risk of identity theft. Gee, what a hell of a brokerage. Unauthorized access to their systems. From June of 2021 through November of 21, Robinhood failed to adequately address known risks posed by cybersecurity vulnerabilities related to remote access to their systems. In November of 21, a third party obtained unauthorized access and downloaded information related to millions of individuals who had provided that information to Robinhood. Of course, your information is safe with Robinhood. No problem. Oh, off-channel communications. Robinhood had long-standing failures to maintain and preserve electronic communications in violation of the record-keeping provisions in federal securities laws. Both of Robinhood's firms admitted to the findings in the order concerning their off-channel communications. Retention of data. Robinhood failed to maintain copies of their databases in a manner that ensured legally required records were protected from deletion or modification. Gee, I wonder why they would do such a thing. Failure to maintain customer communications. Robinhood failed to maintain some of their communications with their brokerage customers as legally required. In addition, Robinhood Securities alone committed the following violations. Big ones: electronic blue sheets for more than 5 years. 5 years, ladies and gentlemen. Robinhood Securities failed to provide complete and accurate securities trading information, known as blue sheet data, to the Securities Exchange Commission. Robinhood Securities admitted to the SEC's findings concerning blue sheet filings for 5 years. Get it? In connection with their stock lending and fractional share trading programs, Robinhood Securities failed to comply with Regulation Show, the regulatory framework designed to address abusive short selling practices. From May of 19 through December of 2023, Robinhood Securities violated Reg Show's closeout, order marking, and locate requirements. Robinhood failed to deliver, is what they're saying. Robinhood mismarked short sales as long, illegally cooking the books. Robinhood did not locate shares for naked shorting, meaning Robinhood naked shorted your securities. If you were long, that means you got fucked by Robinhood. I have no problem in saying that. The Securities Exchange Commission has already charged them, and they have admitted to doing these things and paid a $45 million fine. They also found that they violated rules 200G, 203B1, and 204A of Reg Show. For those of you that are wondering, 203B1 is the what makes it legal for market makers to naked short stocks. And of course, Robinhood Securities violated that regulation as well. They order further fines that both firms, Robinhood's, violated Rule 30A of Regulation SP, Rule 201 of Regulation SID, and the broker-dealer record-keeping and reporting provisions of federal securities laws. Both firms admitted certain findings in the order and agreed to be censured. Additionally, both firms agreed to conduct an internal audit. Okay. They agreed to pay, Robinhood Securities agreed to pay a $33.5 million penalty, and Robinhood Financial agreed to pay an $11.5 million penalty, thus meaning that they got a nice slap on the wrist for violating naked shorting laws like it's going out of style. Dave Lauer of Irvin Finance says, Robinhood was fined $45 million today for violations of federal statutes and regulations related to blue sheet filing, short selling, identity theft, record keeping, and suspicious activity reporting between at least 2018 and 2024. Just some small problems, he says. They failed to submit blue sheets and violated Reg Show by not closing out failures to deliver in their fractional trading program. They also mismarked millions of short sales because they failed to calculate their proprietary position. Robinhood's fines continue to increase, hundreds of millions of dollars. That is just a cost of doing business. Robinhood is a poster child for what's wrong with this industry. They flaunt the rules, pay a speeding ticket, and continue with business as usual. And never forget that Robinhood's business model is the exact opposite of Robinhood. There's no such thing as free trading. Instead of paying commissions, they give you inferior trade executions, meaning you lose money every single time you make a trade on Robinhood, and funnel your money to the middlemen, so-called market makers, the wholesalers who internalize your trades and front-run your trades and fail to deliver on your orders and naked short your orders and your stocks before they buy it back to maximize their profits and maximize your losses. And guess what, ladies and gentlemen? This is legal. He goes on to show that by at least October 2020, Robinhood was incurring these intraday net short positions that were causing it to incorrectly mark principal short sale orders relating to fractional trading and recurring orders as long. Ladies and gentlemen, that is cooking the books. Of course, a federal securities violation. Robinhood violated Rule 204A of Reg Show, which requires participant of a registered clearing agency to deliver securities to a registered clearing agency for clearance and settlements on a long or short sale in any equity security by a settlement date, or to close out a failed to deliver position resulting from long or short sale transactions in that equity. Meaning they failed to deliver. They put ones and zeros in your account when you bought a stock and they didn't deliver. They naked shorted and allowed your stocks that you own and that you're long on to be naked shorted by other firms, hedge funds, high-frequency traders, quants, family offices. Meanwhile, you lose money. You lose money on their transactions. You lose money with their payment for order flow. You lose money when your orders are traded in dark pools. You lose money when the orders are internalized. You lose money when they fail to deliver. You lose money when they cook the books. You lose money through these inferior trade executions. And the list just goes on and on and on, but I won't bore you with that. I think you're beginning to understand why Robinhood, just like many of these other brokerages, are screwing retail investors day and night, left and right, every which way you turn. And they're not the only ones doing it, and they haven't just started. They've been doing this for a significantly long period of time. As you can see here, just in September, what was that, 3 months ago? Robinhood Crypto has agreed to pay $3.9 million to settle claims that it failed to let customers withdraw crypto from their accounts for a period of 4 years. They violated laws by preventing customers from accessing cryptocurrencies they had purchased, forcing them to sell their assets to leave the platform. They misled customers about where their assets were held and falsely advertised competitive pricing through trading venues. Again, ladies and gentlemen, if you're tired of this bullshit, retail investors now have the opportunity to own an upcoming stock and crypto brokerage app called Lit Exchange. We have opened a founders investment program, which is offering retail investors such as yourself the chance to own equity in the company and receive a plethora of perks and benefits. This is the first time in the history of the world that this has ever happened. No other brokerage firm has ever allowed retail investors to own equity in the company prior to their launch and prior to their planned IPO. So keep in mind, this is a brokerage being created for retail investors by retail investors with good reason, because your best interests are our best interests. That same cannot be said for companies like Citadel, Virtue, Robinhood, Schwab, IBKR, Fidelity, E-Trade, all these other scumbags that pulled the buy button. Hundreds of broker dealers colluded with clearinghouses and market makers and hedge funds to remove your ability to buy and sell and trade stocks amongst Silver ETF, SLV, AMC, GameStop, COS, and over 50 securities at its peak. Citadel, just so you guys know, just yesterday announced that they are looking to raise at least $500 million from a bond sale. Asset managers may sell notes in range of 5 to 10 years. Banks have arranged calls with credit investors on Monday. Could this be due to the fact that Citadel Securities has over $65 billion worth of securities that they have sold but not yet purchased? This means securities that they have shorted. They have sold them short, meaning they have sold the title to $65 billion worth of cars on fair market value. And when they have to buy the titles back for these vehicles, oftentimes they're rehypothecated, and the same title belongs to many different vehicles. How can that be? It can't. It's impossible. They cannot possibly deliver the same title to many of these vehicles' new owners. Hence, the potential for massive short squeezes like we saw in 2021, and even as recently as May of 2024 with AMC and GameStop, and that we have seen just yesterday with DJT, and we've also seen with many other stocks out there. Take a good look at this. We can even ask AI, and let's actually do that. I'm going to do that for you right now, so you guys can get an idea of what AI thinks, not what I think, right? And it's not perfect, but it does have access to pretty much everything on the internet. Why would Citadel Securities issue a $500 million bond sale on Monday, January 13th, 2025. Are they concerned about their financial position? I will pull this over to the screen so you guys can read this as well. They do not believe that they are issuing bonds as a common practice among large financial institutions to secure capital for various purposes, such as funding new investments, expanding operations, or refinancing existing debt. Why would they want to possibly refinance existing debt? If they have so much money and they're so profitable, if they had a net capital of $300 million in excess of the required minimum as of June 30th of last year, and generated $2.3 billion in net trading revenue in the first quarter of 2024, why do they need $500 million more? Are they possibly concerned about their collateral positions? Could they need the money in order for their new Texas exchange deal with BlackRock? I'll tell you what, guys, any company who's out there like Citadel Securities that is trying to create a competitor to the New York Stock Exchange in conjunction and in partnership with BlackRock is something that I would be very concerned about having any company or investing in whatsoever, no matter what company was in that stock exchange. We all know that Citadel Securities has, for a long-standing period of time, been using payment for order flow and dark pools to suppress prices on securities. Would I want my company or would I want to invest a dime or even a penny in any company on an exchange owned and operated by Citadel Securities and BlackRock? I'm pretty sure that's a rhetorical question. You can think of what that might mean for yourself. Yeah, Andrew, when they're borrowing at these high interest rates, issuing bonds at these high interest rates, and selling notes at these high interest rates, that's not exactly a great sign. Some of these memes over here. Ken Griffin has entered the chat. Let's see what Dario has to say here. I thought this to be pretty interesting. What a great coincidence that this pops up exactly the same day we warned about GameStop swaps were starting to enter forced delivery. Does Kenny need money to meet margin call requests by chance? A lot of people are saying that they need collateral. $500 million are a lot of bedposts. The name is Bond. Junk Bond. Remember, this is the guy that sets the price. We set the price of securities, as Ken Griffin likes to say. And this is nothing new, ladies and gentlemen. Stock brokerages have been naked shorting on behalf of their hedge funds literally for decades. Here's an article from 2005. Yes, I went all the way back out to 2005 to prove this to you guys. Stockbrokers have been naked shorting on behalf of their hedge funds literally for decades. Market makers did the same thing to stocks like GameStop and AMC and the SLV ETF to illegally manipulate markets. The stock brokerage, RYCO, registered as a market maker in order to short sell stocks on behalf of a hedge fund. On behalf of hedge funds, by registering as a market maker of certain securities way back in 2005. Hedge funds were unable to sell certain stocks short because they could not meet the requirements. Citadel has done the same thing as alleged in this interview, according to 45-plus year hedge fund manager Charles Gradante, as he sits next to two, not one, but two top-level Citadel employees. In case you haven't seen this, I'm going to show this to you again. You can see something that this is happening over and over again with every company. Here's Morgan Stanley doing the same. It is really unbelievable, ladies and gentlemen.
I want to be clear, I do not respect the SEC.
We made the decision in the morning to limit the buying of about 13 securities on our platform. So we're really in unprecedented times. In order to protect the firm, we had to limit buying.
That markets are efficient because of active managers setting the prices of securities. Firms like Citadel, we're all running large teams of people that are engaged in fundamental research, trying to drive the value of companies towards where we think they should be valued.
Sam Bankman-Fried and FTX, he's been charged by US courts and the SEC with money laundering, conspiracy to commit wire fraud, and securities fraud for the collapse of FTX. The former chairman of NASDAQ, Bernie Madoff, built the largest Ponzi scheme in history. Over 4 decades, he faked records of annual gains to investors who thought he was investing their funds, when in fact, he was just using new investor capital to pay off older investors.
But the synthetic shorting and naked shorting, which is illegal, market maker can execute naked shorts insofar as they're facilitating a trade. The regulators are looking at that now as to whether or not there was this naked shorting by the market makers on behalf of the hedge funds in order to facilitate the shorts, and I think they're going to uncover that there were some issues there. But the penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and all of the players get fined constantly for doing this.
Hedge funds and other Wall Street firms have teams of analysts working together to compile research and analyze shares of companies. Individual investors do not have those resources.
I basically would like to ask the SEC why they didn't act on the morning of January 28th, because I was so scared, I can't tell you how scared I was. I was so scared, I can't tell you how scared I was.
Well, Thomas, what were you scared about? What does failure look like? You said we came close to breaking. What were you scared of?
I was scared of a domino bankruptcy. I tell you, the rules require the long brokers to go into the market and buy the shares at whatever price. So that drove the shares up to $480, and then suddenly it didn't go further.
Suddenly we pulled the buy button.
Come further.
So buying and selling those 200 shares would make the market maker $1. But as millions of shares are traded, the profits from the spread add up. In 2020, these brokerages collected almost $2.6 billion in payments for stock and option orders.
Boom.
These brokers, including Interactive Brokers and Robinhood, that generate revenue from selling the order flow to market makers.
Business has always been done like this on Wall Street for over 100 years.
Our orders compete against each other to get the best prices. But if the order instead is routed to a wholesaler that has agreed to pay for it, the order is not
Citadel.
going to an exchange and is not necessarily receiving the benefit of that broader competition.
As you mentioned about commission or zero commission does not mean it's free. It does have some cost inside. Some brokers have payment for order flow.
Disclosure alone, by enhancing the disclosure around payment for order flow, really will address it. United Kingdom, Canada, Australia, all have banned payment for order flow. I know we have different markets, different systems. We even have letters that we've gotten over the years, dating back over the last 20 years, articulating why it's not good for our system. So I really ask staff to consider that, but also to consider it only in the context of the entire market structure.
On January 28th, our daily deposit requirement was 10 times more than on January 25th. As a result, Robinhood Securities imposed temporary trading restrictions on certain securities. Robinhood Securities put the restrictions in place in an effort to meet increased regulatory deposit requirements.
You don't say.
The decision to restrict trading really was internal to Robinhood. We did not have discussions about that.
Like GameStop, AMC, all these meme stocks have brought naked short selling really to the forefront of the market's interest. This is something that's going on for a very long time in the small cap market and is very much a problem.
Has your husband ever made a stock purchase or sale based on information he received from you?
No, absolutely not. Okay, thank you.
Those are fully collateralized tokens.
That markets are efficient because of active
Oh,
managers
look, another Robinhood
setting the
find.
prices of securities.
The order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.
What a surprise. Ladies and gentlemen, Robinhood was also fined in this video. And we found that Robinhood was in fact naked shorting securities and violating regulations show. And guess what? We now have confirmation, proof, yet once more. It's not the first, the second, or the third, but there's just happened dozens and dozens of times now in which we have proof that Robinhood has been cooking their books, failing to mark their shorts as shorts. They're marking them as long positions, turning a liability into an asset illegally. If any of us had done this, we'd go to federal fuck me in the ass prison. But Robinhood and Vlad Tenev and company can do this, steal directly from your investments, and get away scot-free. Yet people continue to use these fucking broker dealers. What can I say? I couldn't find one that I trust because they're all run by the same people. So we decided to create our own. Think about that. Wolfie says, year after year of lip service and bullshit, enough is enough. Change. We want change, damn it. And I completely agree, my friend. It's in the name. Lit Exchange. Enjoy the rest of your day, folks. See you for another video tomorrow. I wish you peace and wealth. WGBS FR.